Hey everyone, it's PJ Patterson here. Just get the bubble resized for a market update. Today is April Fool's Day, 1st of April. There is a tremendous amount going on in the markets, and one would think with the recent action in the ASX as well as on the US markets and even around the world that we might be seeing some signs of a rebound or some sort of bounce. Unfortunately, I'm going to put a damper on that today because we are in a bear market. There is zero doubt about that. We're in a bear market, and typically what happens is in bear markets, you get these violent reactions back to the upside. So you'll see violent downside movements, which we've seen, and then you'll see some sort of a bounce, and that bounce could be quite substantial, like we've seen a 6, 7, 8% bounce in the ASX. What's interesting is that very little of that bounce has stuck, and we're still in, as I said, a bear market and a downward trajectory. Furthermore, the data is not getting any better. So I'm going to start off really by just saying I'm having a lot of conversations with colleagues and clients that are suggesting to me that people continue to get laid off or scaled back in terms of their hours worked. Businesses are shutting. If they haven't shut already, they're shutting. They're laying off people themselves. And I think the outlook is not good, and it's not good for the short term. It's not probably very good for the medium term, although we just are going to have to see how this plays out week to week. Like, you really can't get much more visibility on this than the next 1 to 3 weeks. That's it. That's all we really have available to us. So I can't sit here as an advisor and a person who relies upon empirical data and say to you with any equivocation that in 6 months' time everything's going to be back to normal. And really, there is not going to be a return to normal. I think one of the positive unintended consequences of all of this is that we have driven ourselves closer to and deeper into, not closer to, but deeper into the digital economy. And we're going to, if we haven't already, we're going to realize that, yes, the workforce can work from home. And yes, we can be productive and still get our jobs done without having to come into an office environment. So, that's one positive thing that I think we'll see. But I wanted to get into a couple of data points and a few other things today that may temper any enthusiasm that you might be having right now for some of these bounces that we're seeing in markets, because I believe, and the data is pointing us in the direction that we're going to see continued further downside. And so, first of all, I wanted to just touch on obviously where we're at with the coronavirus, COVID-19. There's going to be, it looks like another cycle. So it may be starting again in Australia, I'm not sure, but it appears as though the cases and the deaths are rising, although in Australia we haven't had a lot of deaths, which is good for us, nor cases really for that matter. But I think they've done a reasonable job of trying to isolate people and get them to get that done so that we stop the spread of this virus. But in the U.S. in particular, it looks like they're still ramping up. And one of the things I'm very curious about with China, they're trying to restart their manufacturing sector. And what I'm curious now to observe and to watch is whether or not there will be a resurgence of cases. Now, I don't believe any of the data that comes out of China anyway. And they just released a PMI number that was not based on any survey or anything else. It was just basically a fabricated number that said that they were, I think their PMI was back at 51 or 53 or something like that. Actually, I might have that on some of my research stuff here. Yeah, 53, which is a complete, absolute BS number. Like, the composite PMI doesn't go from 28.9 to 53. It's just bullshit. And this number, 35 to 52. Ladies and gentlemen, you cannot do that in a month. That is just not possible that would happen. So the number's clearly it's clearly fictitious. In any case, I'll just go back to that page. In any case, the rest of the data that Hedgeye are providing to us on a variety of countries is all red. It's ugly. It's bad. And it is probably going to continue to deteriorate. And one of the things I wanted to just draw your attention to was this particular update on GDP in the U.S. What they're predicting is a GDP, and I'll just get you to sort of focus on the right-hand side of this. The GDP figure for the first quarter of this year could very well be minus 5% in the U.S. That's what they're calling for anyway. And furthermore, in the second quarter, it could be down almost 25%. Now, any way you slice it, it doesn't matter if it's 25 or 20 or 15, minus 15. The number's going to be really, really bad. And that should signal another round of, I suppose, sell-off in the market and everything else. People are going to go, oh my God, where are the corporate earnings going to come from? How are we going to have any upward bias in markets with these kind of numbers? And the fact is, there won't be any upward bias in the markets. They'll continue to go down, and we may see that additional 15 to 30% sell-off in the U.S. markets over the course of the next few months. Another really interesting table that I wanted to share with you as well, and Hedgeye are very good at doing this, putting things in historical context, because we do need to know what happened in the past in order to sort of get a gauge on what's happening now. And as Mark Twain famously said, history doesn't repeat, but it rhymes. So the thing I want to draw your attention to on this particular chart is right at the very top here, of this table rather, is the only reference point. There's only two reference points we really have for a GDP figure that is as negative as they're predicting this GDP figure to be. And if you haven't guessed it already, it was the Great Depression and the stock market crashes in 29, and then the Depression era of 37 to 38. And so as you can see here, these are the two figures. So minus 26.7% GDP from 29 to 33 in that period. That was peak to trough. And then 37 to 38, minus 18.2%. And what I want you to do with this, to put it in context, is the Great Depression of 29 to 33 the duration of that lasted 44 months. So that's almost 4 years, right? 12 months in a year, 4 years, 48 months. 44 months, almost 4 full years of depression type environment. And a lot of people are out there right now, traders and other people are out there going, oh, yay, the Fed has come to the rescue and is printing money and flooding the market. And now fiscally, we're getting governments doing the same thing. And they're expecting this whole shit show to be over within a month or 2 months. Well, I've got news for you. The best that we have ever had in a financial crisis, where you have declines in GDP, was when we had this little blip decline in GDP back in the 2001 period, which was the tech wreck, if you remember that. And it took 9 months for the market to go through that process. So we're like in month number 2 of this shit show, right? And so I've got news for anybody out there who is I'm not going to say dumb enough, but mistakenly thinking that they should be buying these dips in the market. They're going to get hurt badly. Their capital is going to have a drawdown. Now, unless they're trading it, and that's a very hard thing to do in the short term, they're going to get hosed. And so I wanted to give you some context around where we're at. So it could be anything in between all of this. Like, we may not have a minus 25% GDP figure. It might be something less bad, but it's going to be bad. And sort of, if you look at the durations here, you're looking at a minimum 9 months, a minimum 7 months here in the oil price shock back in the 80s, but this is much worse than that. I don't think anyone will argue that. Upwards, of course, to the Great Depression stuff, which was 44 months and then 14 months respectively. So we're probably looking at somewhere between 12 months and, who knows, 24 months before we are completely out of the woods on this. And who knows, it could just take longer. So I'm not going to rant anymore about that, but I just want you to put this in perspective, that we are in the first couple of innings of this particular draw down in markets, in this bear market, and it's not going to be corrected in 10 minutes time. So that's one of the things I wanted to just share with you today. The other thing is that, and again, I just want to remind you that we're positioned right now in predominantly cash and treasuries, and I'll be looking to probably exit our treasury position soon, because what we're going to find is that rates will continue to fall, because the Fed is in the market buying assets. It's buying treasuries. It's buying assets now. It has basically said last week, or whenever they had their last meeting, could have been almost 2 weeks now. They've basically said that we're QE to infinity. We're going to do almost whatever it takes. So they're trying to support the market by buying assets. Now, again, I said it before in the updates, and I'll say it again. I point you to the Japan experiment. This is what Japan's been doing now for the better part of the last 5 to 10 years, and it has not helped them at all. So it's quite clear that that doesn't work as a long-term strategy. It might support the markets in the short term because you throw enough, you throw enough money at something in the short term, and of course you can get some sort of effect. But over the long term, it just isn't going to work. So that's probably point number 2. And then let me just jump into maybe a couple of the other charts here. I'll just quickly go back to, let's see, is there anything else I want to show? Yes, there was a chart here. So I've shown this a couple of, here we go. I've shown this a couple of times. Sorry for all the clicking around. Where we're looking at the quadrant expectations, right? So you know that part of this strategy that I use is the 4-quad model as produced by and guided by Hedgeye. And you can see here, this is Q2 of 2020. Every single G20 country except Mexico, and they could still get there, is in quad 4. It is horrendous. Now, I'm sure your eyes will be gazing towards the third quarter and fourth quarter with these numbers. And before you get too enthusiastic about it, going, yay, it's only going to last 1 quarter, and then we're back to sort of growth in quad 1, I would say we've got to wait and see what the data tells us is going on under the surface. And I dare say that these will be revised going forward as we get further data points coming through. So again, this is just another, I'm not trying to be pessimistic, and I hope you guys understand that these updates aren't about being pessimistic. They're about being realistic and dealing with the market conditions that we have and the economic conditions that we have, and how that translates into me investing your money, or in this case, not investing it because the market is so volatile and so bad at the moment. There's just not a lot of opportunities out there. To that end, and I don't have the vol charts up at the moment, I could probably just quickly jump on the U.S. markets and get the vol figure here, the VIX. It has come down a little bit, so that's good, but it's still in the uninvestable bucket, and it's still this way for a number of asset classes. The VIX is at 50, closed last night at 53. Might spike tonight. I think we're already calling, I'll just look at the pre-markets real quick. I think it's already looking like a couple of percent potential decline. Yeah, I mean, here we go. We're probably almost limit down on the Dow, and that's because the market, there was a number of technical things that happened last week. We had a rebalance. We had some other stuff that saw money flow into stocks. But here we go. That's done, right? That's finished, and here we are at looking at a negative open. So, and of course, this could reverse before the market opens in another 5-6 hours or whatever. But the point I'm trying to make is right now is the time to sit on our hands and do nothing except be positioned as I have already described. I see very little possibility for any change in the short term or even in the immediate term around volatility and around the change in narrative around the economy. And again, that pretty much makes 95% of the market uninvestable. Even treasuries now are getting to the point where it's a 50-50 sort of thing, where you would not necessarily put on new treasury positions, but you would stick with what you've got because it's because the Fed is in the market doing things, and interest rates will continue to fall as the Fed buys more bonds. Anyway, that's probably enough of a rant for today, but I do hope that you're finding these check-ins and these little bits of analysis that I'm doing for you on the fly, real time, useful. And the other thing I just wanted to ask you, and I'll continue to ask this question, you might get some emails and stuff on this. Please tell me, hit me up in the comments, shoot me an email, whatever, in the boardroom. Tell me what it is that you need commentary on. What do you want to know about? Are there any specific questions about investments or some of the government programs or anything? Just anything. You can hit me up with anything. If I don't know the answer, I can't comment on it, then I'll see if I'll reach out to my network and I'll see if there is something that someone I should say that I can find to bring in and be a guest to something like that on a podcast or a web event to have a conversation about for you. So please do hit me up and let me know. By the same token, and you would have now probably seen the video that's gone out to my entire database, please hit me up with any help or any conversations, anything you need to have around financial stuff. I'm absolutely here to help you and to tell you what I think's going on and tell you the best way I think we should be handling stuff. So guys, have a nice evening, and I will look forward to my next update and my next market commentary. Cheers.